Hello and welcome to this video on AQA A-Level Accounting Section C with an example of a written question which is going to be on capital investment appraisal. So, the directors of Winning Sports Limited are considering two alternative investment projects. Whichever project is chosen, the company will have to borrow the initial investment at a variable interest rate of 6% per annum. Now, first of all, Project A. So Project A involves the conversion of a local village community shop and cafe, which is run by volunteers, into a branded sports shop, which will be run by trained specialist staff from outside the area. The current shop is thriving, but continually makes a loss. Now, Project B involves extending a sports pavilion in a deprived community. The extension will include a changing and sports facilities for both women and people with disabilities, as the current pavilion only has a male changing room. The project will involve creating up to 5 jobs for people from the local community. Now, I've highlighted in yellow some important points in these two projects. Now, the accountant of Winning Sports Limited has carried out investment appraisals on both projects, which is as follows. So we do not need to do the calculations here, they've all been done for us. So the initial investment for Project A is £60,000 and Project B is £110,000. So straight away we can see that Project B is £50,000 more for initial investment than Project A. Now we'll get to that in a few moments later on. The net present value for Project A is £80,000, whereas Project B is £150,000. So again, Project B has got a greater net present value than Project A of £70,000. The payback period is 3 years for Project A and 2 years for Project B, and the estimated life of the project for Project A is 10 years and Project B is 8 years. Now, the net present value is calculated using a discount rate of 9% for both projects, and this was based on the current return on capital employed of 3% plus the interest rate of 6%. Now, let's see what we've got to do. Assess the two projects and recommend to the directors of Winning Sports Limited the one they should accept. So we must assess both of the projects, Project A and Project B, and we must make a recommendation at the end, because it says, and recommend to the directors the one they should accept. So let's look at a solution plan. So I'll put various headings in the solution. Now the bits you would write in your actual answer are the sections that are written in blue. So let's see what we got. First thing is you're going to start with a short introduction on what your assessment is going to be about. So for this little assessment, I'm going to say, this is an assessment and recommendation on which of the two projects, A and B, the directors should accept. So basically taking that directly from what the question is asking us to do. Then I'm going to compare the financial data which has been provided for the two projects. So we've got the initial investment for Project B of £110,000 is £50,000 greater than the investment in Project A of £60,000. So I found the difference there between the two investments for the projects. The initial investment of Project B is 83.3% greater than for Project A. Now, when you put down some calculations here, you must show the calculations. Where does the 83.3% come from? Well, it's the increase of £50,000 compared to Project A's investment of £60,000, and to convert it to a percentage, you times 100. That's where the 83.3% comes from. So the initial investment of Project B is 83.3% greater than for Project A. As the initial investment will have to be borrowed, that could have an impact on which project should be undertaken. If the borrowing resources are limited, then it may not be possible to borrow the money for Project B. Now there's interest charges here. So as there will be interest charged on the amount borrowed, that will affect the profit of the business. The interest charge will be at a variable rate of 6%. Now at a rate of 6%, the interest charge on Project A would be £3,600. So you see again in brackets, I've put where that figure has come from. It's the 60,000 times 6%. So you must put where the figures come from, how you've calculated it. Whereas the interest rate for Project B will be £6,000. So again in brackets, I've got how that figure has come about. It's £110,000 for initial investment times 6%. So this implies that Project A would have a greater reduction on the profit of the business compared to Project A. So, sorry, this implies that Project B, it should be, would have a greater reduction on the profit of the business compared to Project A. The difference would be £3,000. So again, where does that come from? That comes from the £6,600 for Project B compared to the £3,600 for Project A. Now, the shareholders of Winning Sports Limited may not be happy with this reduction, and also the interest rate is variable. If it's variable, it means it could change. so it could result in either a higher amount of interest or a lower amount of interest being charged. So based purely on the initial investment amount, Project A is the more preferable project because of a smaller amount. Now we come to the net present value. The net present value of Project B of £150,000 is £70,000 greater than the net present value of Project A of £80,000. This tells us that over the life of the project in today's monetary terms, Project B would generate more net income than Project A. However, any change in the interest rate would affect the amount of the net present value, and also we do not know how accurate the cash flow forecasts are, as they are predictions of the future. The further out the predictions are from the current time, the less accurate are the cash flow predictions. So based purely on the net present value calculation, Project B is the more preferable project. Now the payback period. The payback period for Project B of 2 years is 1 year less than the payback period of Project A of 3 years. This tells us that Project B will return the initial investment amount 1 year earlier than Project A. So this suggests that Project B is a less risky investment based on the payback period calculation. The cash flow forecasts, again, there are predictions as mentioned above, so we do not know how accurate the payback period calculations are. In addition, the cash flows after the payback periods are not taken into account in the payback period calculations, and there could be significant cash inflows for one of the projects after the payback period, but they will not be taken into account in the payback period calculation. So based purely on the payback period calculation, Project B is the more preferable project. Now the expected life of the projects. The expected life of Project A of 10 years is 2 years greater than the expected life of Project B of 8 years. Now we need to consider how accurate the expected life of each project are, as they are based on predicted figures. So also there has been no mention of the extended life of each asset could be extended at the end of each project. So based purely on the estimated life of the projects in the question, Project A would be preferable. Now we've got to compare the non-financial information of the two projects. So let's see what we've got then. So Project A involves the conversion of a local village community shop and cafe, which is run by volunteers, into a branded sports shop. Now this would not be welcomed by the local community. So we'll say why now. The meeting place for the community would be lost. This would have an effect on the well-being of the local community. In addition, the volunteers would lose their volunteer work, which again would affect their well-being. There would be no employment options for the local community, as the branded sports shop would employ trained staff from outside the local area. The branded sports shop would also cause disruption to local roads and parking, which could have a detrimental effect on the environment of the local community. Now, Project B. Project B involves expanding the sports pavilion, which would include changing facilities for both women and people with disabilities, whereas before there was only changing facilities for men. This will make the sports facilities all-inclusive. The sports facilities will provide health benefits for the local community, and also there would be the creation of 5 jobs for people from the local deprived community, which would be beneficial for their financial and well-being needs. Now, however, there may also be disruption to local roads and parking, which could again have a detrimental effect on the environment of the local community. And based on the non-financial information alone, Project B would be preferable. Now we need to write a conclusion of our assessment, and we must include our recommendation. So based on the financial factors, we can summarize that Project A would be the more preferable based on the initial amount of the investment. Based on the net present value, Project B would be preferable. Based on a payback period, Project B would be more preferable. And based on the estimated life, Project A would be preferable. Now, based on the non-financial information that we just mentioned, Project B would be the preferable project. So overall, I would advise the directors to choose Project B, as non-financial information is a lot more beneficial to the community than that of Project A, and Project B has a greater net present value and a shorter payback period than Project A, making it a less riskier investment. However, Winning Sports Limited could offer a range of sportswear in the community shop to help make it more profitable. So that's a suggested answer to this written question in Section C on investment analysis on payback periods, net present values, and amount of investments, plus non-financial factors as well. So I hope that's helped you. So thank you for watching and listening. So take care then. Bye-bye.